Sarah buys her second rental property at 34. Derek takes his bonus and maxes out his Roth IRA and then pours the rest into a taxable brokerage account. They both feel like they figured something out. They're both right about the destination and completely wrong about the road. Because the difference between building wealth slowly the right way and building it slowly the wrong way isn't which asset you pick, it's what that asset costs you in ways that never show up on a spreadsheet. And the number that separates them by year 25 will not be what either of them expected. Let's build this from the ground floor. Sarah and Derek both got a $40,000 bonus at work this year. They both make $70,000 a year in salary. They both own a modest primary residence already. They're both 34 years old, both in the same mid-sized city. Both have roughly the same financial literacy, which is to say, they've both read a couple of books, listened to some podcasts, and think they have a handle on what smart people do with money. The only thing that's different is the decision they make on a Tuesday afternoon when that $40,000 lands in their checking account. Sarah calls her real estate agent the next morning. Derek logs into his brokerage account at lunch. Neither of them calls each other. They probably should have. Sarah finds a duplex. 2 units, $200,000 purchase price. A solid rental neighborhood. The kind of street where the lawns are mowed but nobody's driving a new car. She puts $40,000 down. Exactly 20%. Takes out a 30-year mortgage at 7.25% interest. Her monthly mortgage payment comes out to about $1,092. Unit A is already rented for $850 a month. She puts Unit B on the market and lands a tenant at $900 a month. Total incoming rent, $1,750 a month. Total mortgage, $1,092 a month. That's $658 a month, in what Sarah immediately starts calling profit. She tells her sister about it over dinner that same week. Her sister is impressed. Derek's move is quieter. He maxes out his Roth IRA for the year, drops $7,000 in, and puts the remaining $33,000 into a taxable brokerage account invested entirely in a total market index fund. His average expected annual return, based on the historical performance of the U.S. stock market over any 25-year rolling period, is somewhere between 9% and 11%. He sets up a $400 automatic monthly contribution from his paycheck and, critically, never adjusts it when things get uncomfortable. He does not call anyone about this. He does not bring it up at dinner. There is nothing to say. He clicked a few buttons and now he waits. Sarah feels like she's building something. Derek feels like he's watching something. That gap in feeling is not a small thing. It will test Derek in ways he doesn't see coming, but the feeling of building something will test Sarah in ways she also doesn't see coming, just with a lot more paperwork involved. Here is what year 1 actually looks like for Sarah. Total rent collected, $21,000. Total mortgage payments, $13,104. Gross difference, $7,896. Sounds like progress. Now let's subtract what she didn't account for when she did the math on a napkin in her real estate agent's office. Property taxes on the duplex, $3,400 per year. Insurance for a 2-unit rental, $1,800 per year. Unit A's tenant had a plumbing issue in April that cost $680 to fix. Unit B's tenant moved out in September, which meant 1 month of vacancy, $900 in lost rent, plus $350 in cleaning and small repairs to get it ready to relist. She spent about 6 hours finding and screening the new tenant, doing showings, handling the lease paperwork. She does not charge herself for those hours. Most landlords don't, and that's one of the fundamental accounting errors of the entire asset class. Net cash flow for year 1, after all real expenses, somewhere between $800 and $1,200. On $40,000 invested, that is a cash-on-cash return of roughly 2 to 3%. Not the 20% she described to her sister. Not even close. But here's what Sarah does have that Derek doesn't. She used $40,000 to control a $200,000 asset. That 5-to-1 leverage means that every 1% the property appreciates, her equity grows by $2,000, not $400. In a market that appreciates at a modest 3.5% a year, her $200,000 property is worth about $207,000 at the end of year 1. Her equity just went up by $7,000 from appreciation alone. Add in the principal she's paid down on her mortgage, roughly $1,500 in year 1, and her total equity gain on paper is pushing $8,500 to $9,000. That's the real story, not the cash flow. The cash flow is almost a distraction. The leverage is where the wealth is. Derek ends year one with a portfolio worth roughly $81,000 to $84,000. His $40,000 grew somewhere between 9 and 11%, plus he added $4,800 in contributions. No phone calls from tenants, no repair invoices, no Saturday morning showings. He went on a camping trip in October and didn't think about his investments once. Let's talk about year three, because this is where things get interesting and where most people start drawing the wrong conclusions. Sarah is now running a tighter operation. She's raised rents to $950 and $1,000 per month. She's been through 2 tenant turnovers total across both units. She replaced the water heater in Unit B, which cost $1,100. She had 1 month of overlap where both units had tenants, and 1 very bad month where she had to threaten eviction and ended up eating $1,200 in legal consultation fees before the tenant voluntarily left. She self-manages everything. She estimates she spends about 4 to 6 hours a month on the property on average, but that average includes 3 months where she spent almost nothing, and 1 month where she spent 3 consecutive weekends dealing with a mold issue in the basement that turned out to be a minor condensation problem and not the structural catastrophe she spent 2 weeks convinced it was. Her total actual net cash flow over 3 years, every dollar that came in, minus every dollar that went out, is approximately $4,000 to $6,000. Her property is now worth approximately $214,000 to $222,000. Her remaining mortgage balance is about $188,000. Her equity is somewhere around $26,000 to $34,000. Combined with cash flow, her total real financial gain from the investment is about $30,000 to $40,000 on a $40,000 investment over 3 years. That's not bad. Annualized, it's a reasonable return, especially considering the leverage. Derek's portfolio after 3 years, with consistent contributions and market returns, is sitting at approximately $120,000 to $132,000. He's put in $40,000 up front and $14,400 in contributions, $54,400 total of his own money. The rest is the market working. He still hasn't told anyone about it at dinner. On raw numbers at year 3, they're actually close. Sarah might be slightly ahead if you count only equity and ignore time. Derek is clearly ahead if you factor in time, liquidity, and the complete absence of anything that could be called stress. Here's something worth saying plainly about Derek's position that the index fund crowd often glosses over. The emotional experience of watching a number on a screen go up is not the same as owning a real asset, and that gap matters more than most people admit. When Sarah drives past her duplex, she sees something she built. When the market dips and Derek's account shows a lower number than last month, there is nothing to drive past. There is no building that is still there, still rented, still generating income regardless of what a financial index is doing on any given Tuesday. That psychological difference causes real behavior. The average retail investor underperforms the index funds they're invested in by roughly 1.5 to 2% per year, not because the funds perform poorly, but because investors panic at the wrong time, chase performance, and make emotional decisions with money that was supposed to be on autopilot. Derek, so far, has not done that. But the test is never over until you actually need the money. The problem is that nobody stops at year 3. Year 5 is when real estate starts to show you who it really is. Sarah's furnace goes out in February. Cost to replace, $4,200. She had budgeted $0 for this because she knew intellectually that furnaces eventually die, but she had not actually set aside the money because the cash flow math kept coming out tight, and she kept telling herself she'd start a capital expenditure reserve next quarter. Next quarter became next year. Next year became a Tuesday in February, where she's calling an HVAC company and trying to figure out whether she can cover this from savings without touching her emergency fund. She can. Barely. One of her tenants, the longer-term one in Unit A, is now 2 months behind on rent. Not because of any malice. Life happened. Sarah has been patient, and now she's in a position where she either moves forward with a formal eviction process, which takes 2 to 4 months in her state and costs $800 to $1,500 in filing and legal fees, or she continues waiting and continues losing $950 a month. She waits 1 more month. Then she files. The total cost of this single event, lost rent plus legal fees, plus a month of vacancy before the new tenant moves in, is approximately $5,200. That $5,200 represents more than a full year of her actual cash flow from the property. This is not a story about Sarah making a mistake. It's a story about a single asset, single market investment doing what single asset, single market investments do. They concentrate risk, and when risk concentrates, it doesn't send a warning email. Derek, in year 5, watches his portfolio drop 18% in an 8-month correction. His $119,000 on paper. He feels it. Everyone with a brokerage account in that period feels it. The difference between Derek and the average retail investor is that Derek set up his automatic contributions and then deliberately made it hard to do anything impulsive by removing his brokerage app from his phone. He doesn't sell. He doesn't even look that often. His $400 monthly contributions keep going in, buying more shares at lower prices. When the market recovers 14 months later, he's actually in a better position than if the correction had never happened, because he averaged down the entire way through. This is the unsexy superpower of index fund investing. It doesn't feel like a superpower. It feels like watching paint dry in slow motion, while occasionally someone tells you the paint is the wrong color. But it works. By year 10, here's where our two investors stand. Sarah's duplex is now worth somewhere between $280,000 and $300,000. Her remaining mortgage balance is approximately $155,000. That puts her equity at roughly $125,000 to $145,000. Her total out-of-pocket over 10 years beyond the original down payment, real money actually spent on repairs, vacancies, legal fees, insurance, taxes, and the furnace situation, is somewhere between $30,000 and $45,000. She has also spent an estimated 400 to 600 hours managing the property over the decade. If you valued those hours at even $20 an hour, that's $8,000 to $12,000 in uncompensated labor that does not appear anywhere in her return calculations. Most landlords never run this number. If they did, it would change the conversation. Her annualized return, when you account for total equity gain minus all real costs, including a conservative estimate of her time, is somewhere between 8 and 12%. That is a genuinely good return. It's also a return that required a furnace replacement, an eviction, a mold scare, roughly 1,000 phone calls and text messages with tenants, and a Tuesday in February she would rather forget. Derek's portfolio at year 10, with original investment plus $48,000 in total contributions and consistent market returns, is sitting at approximately $245,000 to $275,000. He spent $88,000 of his own money. The rest is compounding doing what compounding does when you refuse to interrupt it. His annualized return from the market itself is in the same ballpark as Sarah's, somewhere between 9 and 11%. But unlike Sarah, if Derek needed $50,000 tomorrow for a medical emergency, a business opportunity, a family situation, or literally anything else, he could have it in his account within 3 business days. Sarah's $140,000 in equity is not accessible without either selling the property, which takes months and costs 6 to 8% in transaction costs, or taking out a home equity loan, which takes weeks, involves underwriting, and adds debt. Liquidity is not glamorous. Nobody puts it on a thumbnail. But the inability to access your wealth when you actually need it is a cost, and it's a cost that compounds in the wrong direction when life decides to test you. Think about what liquidity actually means in practice over a 25-year horizon. It means Derek can change jobs without financial panic because his emergency fund is separate from his investments, and his investments can be accessed if a true emergency exceeds that fund. It means if a business opportunity shows up at 44, he has options. It means if a parent gets sick at 51 and needs help, he doesn't have to choose between helping his family and selling his primary financial asset at whatever the market will bear at that particular moment. Real estate investors who are equity rich but cash poor face a version of this problem regularly. They have a net worth number that looks great on paper and a checking account that gives them real anxiety. That's not poverty, but it's a constraint that shapes decisions in ways that are easy to underestimate. Sarah's equity is real. It's just not free. Here is the part that nobody includes in the analysis, and it changes the entire picture. The tax math. Sarah has access to depreciation, which is one of the most genuinely powerful tax advantages available to individual investors outside of retirement accounts. The IRS allows her to deduct the theoretical annual decline in the value of her building from her taxable income, even if the property is actually appreciating in value. On a $200,000 duplex, assuming about $160,000 of that is attributed to the structure rather than the land, she can deduct roughly $5,800 per year in depreciation from her taxable income. On a $70,000 salary with her tax bracket, that's potentially saving her $1,200 to $1,500 a year in taxes she doesn't pay. Over 10 years, that's $12,000 to $15,000 in tax savings that have nothing to do with appreciation or cash flow. It is a real number that belongs in the return calculation, and most people forget to put it there. Derek, on the other hand, pays capital gains tax on his gains in his taxable brokerage account whenever he sells. His Roth IRA portion grows completely tax-free, which is its own form of powerful, but the taxable account will eventually generate a tax bill when he accesses it. Index funds are more tax efficient than most investments because they don't generate a lot of taxable events through trading, but they are not tax-free. This is a genuine advantage for real estate, and it's one you should not skip over because it's complicated. The honest truth about where they end up at year 25 is this. They're probably within 15 to 20% of each other in total net wealth, assuming both stayed consistent. Sarah might be slightly ahead if she's in a market with above average appreciation. Derek might be slightly ahead if he stayed disciplined through 2 or 3 market corrections, which historically is the harder thing to do. What nobody models in any of these comparisons is what each path does to the rest of your life during those 25 years. The real estate investor doesn't just manage a property. They become a certain kind of person. They develop a skill set around negotiation, maintenance coordination, tenant screening, and local market reading that has real value and real transferability. Some people find that genuinely satisfying. They like the problem solving. They like the tangibility. They like knowing that even if the stock market went to zero, their building would still be standing and people would still need a place to live. That's a real psychological advantage, and it's not nothing. The index fund investor, on the other hand, develops something different. They develop the discipline of non-action, which is genuinely one of the hardest skills in personal finance. They learn to separate how they feel about the market from what they do about the market. They learn that checking their balance more often doesn't change the outcome. It just changes their mood. If that skill transfers into other areas of their financial life, the compounding effect goes well beyond the brokerage account. Neither one is the smarter person. They're just optimizing for different things. And until you know which of those things matters more to you, the numbers alone will never give you the answer you're actually looking for. But how they got there is a completely different experience of life. Sarah spent 25 years as a part-time property manager. She dealt with tenants, repairs, vacancies, and the particular kind of anxiety that comes from having a significant portion of your net worth tied to a single piece of property in a single zip code. She built real skills. She has a tangible asset she can see and touch. She has stories. Some of them she likes telling. Some of them she doesn't. Derek spent 25 years living his life. His money worked while he worked, and neither one interrupted the other. He never got a call about a broken furnace at 7 in the morning. He never spent a weekend managing a tenant dispute. He never had a single month where his return was negative because someone stopped paying rent. The choice between them is not really a financial question once you get past the numbers. The numbers are close enough that they can't make the decision for you. The real question is what you want your relationship with your wealth to look like. Do you want to be an owner who operates or an investor who waits? Both are legitimate paths to the same destination. Both will get you there. The difference is entirely in what the ride feels like. And the real mistake, the one that costs people the most money, is not choosing real estate when they should have chosen index funds or choosing index funds when they should have chosen real estate. The real mistake is choosing based on which one sounds more impressive at dinner, because impressive at dinner is not a financial strategy, it's a performance. And performances don't compound. The most boring investment decision you ever make will almost certainly be the most important one. Not the one you're most excited to tell people about. The one you stuck with long enough for time to do what only time can do. Sarah and Derek both figured that out. They just took very different roads to get there. The question is which road you actually want to be on, and if you don't know the answer yet, that means you haven't honestly counted the cost of both of them. So count, because the math doesn't care which one sounds better, it only cares what you actually do, and for how long.